This is video 5 on example 11 dealing with a financial liability debentures at amortized cost. We have had a look at the initial recognition of the debenture at fair value. Now we need to look at the next transaction that also happens on day 1, on initial recognition, on 1 January 2011. And that is our transaction costs. Now, we said that transaction costs are paid to our broker, so credit bank with the 75 Rand. If we are busy with financial instruments, the question is always, where does the debit go? Is the debit, the transaction cost, an expense that goes through profit or loss, or do you take it to the financial instrument? Now, you need to know your rules of financial instruments to answer that question. The only category where the transaction costs on initial recognition are an expense is in the category financial assets at fair value through profit or loss. We are in the category financial liability at amortized cost. The rules of this category are that the transaction costs are recognized in the financial instrument. So the credit entry is fixed. You pay transaction costs, credit bank. The debit entry is the one we always wonder about. And the rules say you take it to the financial instrument, in this case, a financial liability. Now, because it is a financial liability, a liability that gets debited actually reduces the liability balance. So the balance left in your liability is credit of 990 minus a debit of 75. Please don't memorize that for a liability, transaction cost reduce the balance. For an asset, which is a debit entry, if you then debit it some more with transaction cost, it will increase the balance. It's not necessary to learn that off by heart. Just look at your entry for transaction cost. You always pay transaction cost. Whether you have a financial asset or a financial liability, you pay the transaction cost. Credit bank. So there's always a debit entry that we are wondering about. And the debit entry is the financial instrument that you have. In this case, it's a debenture liability because a liability has a credit balance and you are now debiting the liability. It reduces the balance. Because the transaction costs are taken to the financial instrument, in this case a liability, it changes the day 1 measurement. We just saw that the liability is reduced with the effect of transaction cost. That means your day 1 PV changes. Now, when we calculated that PV, we used a timeline and we took all the future cash flows, discounted them back to day 1 using a market rate. That is how we got the PV on day 1. Now we have just changed that PV amount. By taking transaction cost into account, we changed the PV. There is no way that we could, with the future cash flows and the same eye, get back to a different PV, a changed PV, a PV that takes transaction costs into account. Now, our future cash flows haven't changed. The fact that you paid transaction costs does not mean the interest over the term of the debenture is different. The maturity payments over the term of the debenture is different. Your future cash flows have remained unchanged, but your PV has changed. Therefore, your interest rate can no longer be correct. There's no way you could get back with those cash flows to a changed PV by using the same interest rate that you had before. An effective interest rate is that rate that brings the future cash flows back to PV, where PV has already taken the effect of transaction costs into account. Therefore, Therefore, you need to calculate a new effective interest rate. All your other variables stay the same. It's only your day one PV that has changed. So if we now go to our calculator to calculate our new effective interest rate, in this case, we will enter something as cash flow naught. The reason is that we now know what our day one value is. It is the PV that we calculated before, adjusted with the transaction cost. So that is the 990 Rand fair value, the PV, less the transaction cost. You don't need to memorize that it's less transaction cost. Look at your journal entries. It was a debit. A debit to a liability does reduce the liability. Your other cash flows have not changed. They stay the same. Cash flow 1 is the interest of 100 Rand. Cash flow 2 is the interest of 100 and the first maturity payment of 550. Cash flow 3 is the interest of 50. It's different because part of the nominal value has matured, plus the second maturity payment is 600. And now we ask our calculator to calculate IRR. That is our interest rate. It's called internal rate of return. It is your effective interest rate that you will use to account for this debenture going forward. If this question had not had transaction cost, if Annika Limited, the issuer, did not use a broker and did not have to pay transaction costs, you would not need to calculate a new effective interest rate. Then you wouldn't have changed PV. Then the I would have stayed the same. Then you would have used the market rate. Please remember that this IRR, the internal rate of return, the one that we calculated now, it is a market-based amount because our PV was a fair value. It represents a fair value. That then got changed with the transaction cost, but it's still a market-based interest rate, this new effective interest rate that you just have to calculate if there was transaction costs.